Hello guys, so today I'm going to keep explaining what is my strategy of this Warren Buffett dividend portfolio. Remember, the name of Warren Buffett is because for me it's an absolutely icon, he's an idol. He's the best investor of all time. He is humble. He has many great things to teach for all of us. So it's a sign of respect for me to name this portfolio with his name, because I think he's absolutely fantastic, and we all know he's the best investor of all time. So in another video I explain, obviously I'm looking for companies with a very high dividend yield. I'm looking for these companies that have been paying the same dividend even during the pandemic. That means once it's going to be a recovery, I still have a 15% yield, 12% yield, 10% yield, plus the capital gains that you get when the stock is going up. And with time, the yield on cost is going to be absolutely fantastic. I'm looking as well for those companies to beat earnings or beat revenue. As long as they don't cut the dividend, I will keep buying stocks of these particular companies. The second part is companies with a very cheap valuation, a very low P ratio. So I still get some dividend, let's say 2%, 1.5%, 4%, 5%, whatever. So I'm going to show you some examples. So it's here, I have this ready for you. So this is the companies with the lowest P ratio I have currently in my portfolio. Unum, GU, Midlife, Airlease, well, many. As you can see, it's quite a few with a very low P ratio. And as you know, here is the important thing. Here is the data with many studies. In the vertical axis, you have the annualized 10-year return, and at the horizontal axis you have the starting P ratio. So as you can see, if the P ratio is low, like this ones, you have a higher returns for the next years. Yeah, this is what the research and data are saying. So it makes sense to buy companies with a very low P ratio, companies that are still paying you some dividend. The dividend is still high compared with the rest of the years. And here, another chart. I shared this chart in one of my social media. So again, as low is the P ratio, you get high returns for the next years. That's quite simple to understand. Many people probably don't agree with me, but what I just share is data. I just share facts. Then, if someone feel more comfortable to buy Johnson & Johnson, Coca-Cola and Walmart, for me it's absolutely fine. But again, I don't really agree to buy a company paying you 2% dividend at 35 P ratio, or 34, by Apple at 33 P ratio paying you 0.6. For me that's insane. That's not a dividend portfolio. I see many guys doing it even here in YouTube, and they claim they're some sort of experts. For me it's absolutely fine, but I just don't do it. I follow the science, I follow the data, I do my research, and for my past and for what I study and what I know, I do what I understand it works, because at the end of the day, that's my money. Right, so one example I would like to show you is, for example, this company Airlease is the fourth starting from the top. Arlis, the current PE ratio is about 9. But what I really like about this company, if you don't know about this company, I'm going to show you now, is here. And as you can see, the dividend growth rate of this company is about 23% every year. I think now it's a little bit less, So we can say this company doubled the dividend every 4 or 5 years. So let's say you have or you get from this company $100, pounds, whatever you want to is your currency every year. So the year after, you're gonna have about $120. So a 20% dividend growth average per year, that's a lot, and that's a very interesting thing. So that's one of the companies. You might like the company, you might not. The pay ratio is very low. I think could be very interesting. Right, guys, nothing else to say. Have a good day, and remember, if you fancy a girl, just tell her she's great. I have a coffee with her. Remember to tell your parents you love them and look after your friends. So we speak soon. See you later. Bye.